Hello and welcome to Forex Academy, your number one website for Forex and crypto education and analysis. In today's edition, we're going to be discussing when the fundamentals lag behind the technicals. In recent weeks, you will have noticed that the financial markets are in complete turmoil, with extreme volatility in all sectors, but especially in the oil markets more recently, and where the stock markets seem to have been propped up by hope more than fundamentals. After all, many indices have been rallying while the world's economies have ground to a halt, and where the volatility has also spilled over into the currency market. At the end of March 2020, we saw huge moves in currency pairs, including a spike in cable, which only a few short weeks ago was trading at 1.14, and yet has recently spiked up to 1.2640. The fundamentals for the British economy do not support this huge increase in the value of the pound. So what is going on? Well, one thing is for sure, the British economy data releases are not really showing the true extent of the fallout of the COVID-19 pandemic as of yet. And so, the fundamentals are lagging the technicals. In other words, the markets are being driven by technical analysis rather than the fundamental analysis in some circumstances. Something that has stuck out like a sore thumb with regard to fundamentals lagging technicals is the USD CAD pair's recent choppy price action. Let's drill down in a little more detail to try and establish what is going on. Before we do that, let's take a look at the West Texas Intermediate or WTI and observe the price action of the chart of the last 12 months. WTI is the benchmark for crude oil, and during 2019 to 2020, the price of a barrel of crude oil ranged between $50 to $66. West Texas Intermediate is a specific grade of crude that is used around the world and is seen as the benchmark in pricing oil. In this chart, we can see that in the same 12 period, USD CAD ranged between 1.2966 to 1.3575. Obviously, this was just before the virus pandemic. But in case you didn't know, Canada is the fourth largest producer and fourth largest exporter of oil in the world, with 96% of Canada's oil exports going to the United States. Production and exportation of all products including gas and electricity in Canada contributed to around $170 billion in Canadian dollars to its $1.8 trillion of gross domestic product, which equates to around 10% of GDP. And so oil is big business in Canada, and anything that upsets the production of exportation of oil will have a dramatic effect on Canada's gross domestic product, and spillover will of course be the value of the Canadian dollar, where we would expect price action volatility. In fact, Canada has huge reserves of crude oil in Alberta's oil sands and large deposits off the coast of the Atlantic Canada. Oil is very big business here, which includes exploration, drilling, production, field processing, as well as storing and transportation of oil. The Canadian dollar is sometimes referred to as the loonie because of the loon bird as depicted on the Canadian $1 coin. The Canadian dollar is one of the major currency pairs. It is widely traded in the financial markets and has been subject to extreme volatility during the current crisis. However, we have also noticed that the USD CAD price action has become out of kilter recently, and this can be attributed to price action falling out of line with fundamental analysis, and where traders have been preferring to trade on the basis of technical analysis. But be warned, fundamental reasons will catch up eventually and make the relevant corrections. Let's set out by reasoning behind this theory. In this daily chart of the USD CAD pair, we can see that price action, which had previously been contained within the 1.2966 to 1.3575 area, has spiked higher to reach a multi-year high at 1.4664. There are several reasons for this, including the perceived COVID-19 related hit to the Canadian economy, which affected and devalued the Canadian dollar. If we take a look at this chart of WTI, we can also see that the 2019 to 2020 price of a barrel of crude oil ranged from $50 to $66. We can also see that the 2019 to 2020 price of a barrel of crude oil ranged from $50 to $66 has spiked lower to $21 per barrel, and therefore this would have been the main contributor for the Canadian dollar spiking higher because traders envisaged that the low price of oil, which is attributed to a global slowdown and lack of demand, would devalue the Canadian dollar, and that is exactly what happened. Oil price lower, Canadian dollar value lower. Let's move forward to the 30th of April where the price of oil has continued to collapse. At one point going into the negative territory to minus $40 a barrel for WTI for May's future contract, which is the first time in history that this has ever happened. But at this point we can see that the price has somewhat recovered to $11 per barrel, and we might therefore expect that the Canadian dollar has also weakened. However, on the same day of the oil low of the 30th of April, the Canadian dollar has rallied higher in value, with the USD CAD showing a low of 1.3843, which is its highest level in 6 weeks. It then moved higher again to 1.4100, where it currently sits. While some of the increase in value could have been attributed to the oil price coming off its low, especially the minus figures, on hopes of a fuel demand recovery, the prospects of further economic stimulus by the Canadian government and the gradual reopening of Western economies, we can be in no doubt that there has been a lag in fundamental analysis, and where traders have preferred to move with the technical analysis. During the period of the 19th of March to the 30th of April. However, even if things begin to get back to normal, this is going to be an extremely long process, and yet many oil production companies such as Saudi Arabia and Russia keep pumping out oil in high volumes regardless of the slowdown in global economic growth, and where there is a surplus of oil in storage all around the world, it's not likely to be consumed until 2022 according to some analysts. Therefore, no matter what type of recovery we see, and it won't be rapid until there is a cure for COVID-19, on the basis of supply and demand we will see low oil prices for a long time to come. Therefore, we should expect the US dollar CAD to continue to rise, perhaps to previous highs of $1.46, as the fundamentals catch up with the technicals. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.